Hello everybody, Brian here from quantlabsnet.com. In this video, I want to show you two very critical things when it comes to high frequency trading. The first one we are going to look at is basically, let's get rid of these. Okay. So what we're going to look at is we're going to look at the put call parity. This is a critical uh, item which measures the equilibrium of the future or a commodity. And basically, this is again all in development, as I've said before. And basically, the chart would look like something like this, whatever the asset is. In this case, we have a put plus strike plus call put. I believe this is for notional value, this symbol, PVK. What we specifically would look for is equilibrium in the market. So in this case, you're not seeing it. And that means then for a institution that would be a opportunity for trading because now the market has gone deficient in this particular asset at this point in time with a put call parity. So that's how a lot of the firms will use this put call parity. Again, I don't know if this is correct data, correct chart. This is just an example as this is all in data. All right, so just wanted to let you know about that because everything's all about equilibrium in the market, or as some people say, efficiency. But when it goes inefficient, where the put call parity gets messed up and it's not doesn't have equilibrium, then obviously that's an opportunity to trade. How long that opportunity might last could be a couple of seconds. That's where the HFT shops need their milliseconds to take advantage of that and make sure they have the fastest technology to get a trade in and out in pretty well a blink of an eye. All right, so let me show you what we call the gold areas to trade in, the gold area trading zones. So in this one, it's for natural gas. Here you can see, and this contract is only going out to 2 months. So here being March 13, this one would be, actually, sorry, it would be a 3 month chart. So the longer time period you have on time of expiry, the better looking this chart is. But it might not be only accurate because as the time of expiry gets closer, obviously it could be way off. But this just gives you a rough guidance of where to trade within your options. So in this case, we have, I'm not showing it here, but just under $5. But you want to be here and here in your option golden area to maximize the profit. There's also a floor price for the future, so that will protect you on the downside. So that's kind of like where we're at, and you can see here in the legend on what these colored lines mean. But usually it's just right in here. Another example, you won't see it as good. This is gold, um, and this one's only for next month, so this is 1 month out. Problem here is this is where the trading zone starts right here. And then right here on the upper side, and then again, you'll have a floor price set. And again, this is all in development, but just to give you an idea of what to look for on the boundaries of when to trade within options trade um, for a call and a put. And you can do different layering. As I said, you can do a combination with a synthetic option. And then maybe if you wanted with a future price, be able to establish that as the protection. So this is where we're going. We're getting really fast and furious, pretty fast with everything. And I just want to show you where to go in case you want to learn more about what I do. Just go to quantlabsnet.com and it will give you the ability to, okay, let me just go, yeah, there we go. So you go under the Learn tab here at the top, and then you get your opt-in for your email and name and all that. We don't spam. Depends what you define as spam. but every day you may get something, depends on how much you engage with the list. Also, we don't release your information out to anybody. So there's confidence there. And as this is getting developed, you will see in future videos more sophisticated kind of trades analysis with Greeks, analysis with time decay, gamma, vega, all that fun stuff, and futures as well. Simple future contracts as well, if that's what you want to trade. How I envision this is becoming a complete framework of all the tools I've already shown. And the good thing is I can upload, we do hedging math here, arbitrage, and like with that call put parity, that has a lot of math in it, covariance, variance, and all that. So the neat thing about it is when you provide the code of particular Python scripts, because it's written in Python for now, for we call it medium frequency, and then from there be able to use the AI to further update and enhance and tweak potential uh, strategies from that using AI, obviously, in a unique way. And I don't have to do any additional framework, maybe a pricing engine, and then build code from that, be it in Python or preferably in C++ for Linux. So that's how it's being built out. It's going to be pretty powerful and really unique. But for now, we're just doing the reporting. But these are the sort of tools that will be available. And as I said before in prior videos, the data is pretty expensive. So I'm trying my best to mimic it as close as I can on a budget. Thanks for watching. Have a good day and sign up there as I showed you under the Learn tab. All right, see you. Bye.